quickly do this for now. We'll be looking at imbalance for today. So we can make reference to imbalance as um, the gaps between the wicks of successive candles in an impulsive movement. We'll be looking at the graphic representation of it on the chart very soon. And also take note that imbalance could also be referred to as gaps between the wicks of candles. Okay, I've said that. It helps us to mark levels where the market may necessarily retrace into. Yeah, when the market moves rapidly, leaving an imbalance behind, which is a gap, price do come back to fill those gaps. So let's quickly okay, let me go to the Euros. I think I have something there. Okay, yeah. Now please pay attention to this. Let me just look at what I really want you to be looking at for now. I just want your eyes placed on this for now. Let me circle it. Just get your eyes on this for now. Okay. That being said, this is a candle, this is a candle after it, and this is a candle after it. So these are successive candles, one after the other, whether in a bullish trend or in a bearish trend. Now, you take note of this candle wick, this week here, and after the second one, the third one, you take note of the candle wick. You will notice something, that this candle wick here and this candle wick here didn't touch. Now you use something like a line to hold the low. Let me say, for now we don't know if this is a bearish candle or a bullish candle, but we use something like a line to mark out the level of this week and mark out the level of this week. Now between it is what we call imbalance. So between it we have an imbalance existing. I hope you're getting me. Okay, that being said, let's go to imbalance, or it could also be made reference to as inefficiency. So that being said, let's quickly move to look at a balanced or an efficient market movement. Now watch this candle here. You see the wick. Now watch the next candle. Now you see the wick. Now watch the third one. This first one and the third one, they are weak. We're able to touch. When you pull it through with a line, you will see that the price of this week and the price of this week, sometimes they are one. So as a result of this, we'll say this is a balanced or an efficient market movement. So this is a balanced or an efficient market movement. So what do we expect next? We don't see any level that the market will necessarily retrace into. Now let's go to the chart. Let me circle this out. Okay. Now this is a balanced or an efficient market movement. This is an imbalanced or an inefficient market movement. Take note: balanced, efficient; imbalanced, inefficient. Now let's look at something else. Let's go to the chart now. Looking at this chart now, if you see this candle, and this other one, in between it is a form of imbalance. So it's an inefficient market movement. There is a gap between the wick of the successive candle and the impulsive movement. So watch here again, we have an imbalance here, a gap between the wick. Watch this level too, we have a gap between the wick. Now, what did we notice? We noticed that whenever the market moves rapidly, leaving an imbalance behind, price do come back to fill up those imbalance. It's just like you leaving your house, and as you left your house, your door was open. There is every tendency, the moment it comes to your mind that your door is open, you have to go back to get those doors locked. So this is the term or the best analogy I can use to represent it or describe it to you. Now, when the market creates a form of inefficiency or imbalance in the market, it's just like you taking off and your door is open. You have to go back and get those doors locked. So the market will come back to fill up those imbalance. The market is going to come back to fill up those inefficiency. And after it's being filled up, what we have is an efficient or a balanced market. So also, in addition to that, add this to your notes. Imbalance serve as levels where price action may retrace into. They serve as levels where price action are being suspected to retrace into most of the times, and they do. Definitely they do. Definitely they do. When we get to time frame, we'll touch most of all the stuff. So that being said, I have a cool assignment for you now. Go to your chart, try to mark out levels of imbalance or inefficient market movements. Train your eye to spot them. Train your eye to see them. If you watch every imbalance level I marked out on this chart now, the market came back, fill it up. Watch this one, it fill it up here. Watch this one, it had to retrace into it, fill it up, and so on. So that being said, we'll be moving into the next topic. Thank you, keep it up, and please just mark out levels of imbalance on your market. And in addition to that, let me say this: if a zone or a block contains an imbalance, it shows you a level of validity on that zone. That zone is going to be a strong zone. As a matter of fact, the market does two things when it steps into such a zone or block. Is either it reverses it or it respects it. Either the market reverses on it or the market violates it. We're still going to get into that. So you don't just mark out other blocks or zone. You ask yourself, does this zone contain an imbalance? If it does this other block contain an imbalance? If it does, then you highlight it and you extend it to the future. You watch out the market reaction on it as it steps into it in the future. You pay attention to what price action is going to do as it gets into it. As we go further, I have so many entry approach we'll be looking at, and my goal is to keep it as simplified as I can. Thank you.